Something happened in Frankfurt at midnight, and right now no one sitting in this room knows about it. The CEOs of Europe's largest banks held an emergency meeting. The topic? Survival. This wasn't scheduled, this wasn't planned, this was panic. At 11:47 p.m. Central European Time, emergency protocols were activated across 17 major European banking institutions. Not for a cyber attack, not for a terrorist threat, for something much more dangerous. The repo market had frozen. Let me explain what that actually means, because when I tell you the repo market froze, your mind probably goes blank. Repo sounds technical, boring, something that happens in spreadsheets that doesn't affect real people. You're wrong, catastrophically wrong. The repo market is the engine that keeps banks alive overnight. Every single day, banks need cash to operate. They get that cash by borrowing against their government bonds. Safe, reliable, automatic. It's been working the same way for decades, until Tuesday night, when it didn't work. For the first time since the 2008 financial crisis, major European banks couldn't get the overnight funding they needed. Not because they didn't have collateral. They had plenty of government bonds. German bonds, French bonds, Italian bonds, all supposedly rock solid. The problem was different, more fundamental, more terrifying. Nobody wanted the collateral. Think about that for a second. German government bonds, considered the safest assets in Europe, were being rejected as collateral. Not because Germany might default, but because the banks holding them might not survive long enough to return them. This is where things stop making sense if you trust the headlines, if you believe what central bankers are saying publicly, if you think the European banking system is stable. Because on the surface, everything looks fine. Bank stocks aren't crashing. There are no runs on deposits, no emergency press conferences. The European Central Bank is maintaining that everything is under control. But behind closed doors, in conference rooms you'll never see, a different conversation is happening. The conversation started 3 weeks ago, when Italian bond yields spiked to levels not seen since the Eurozone crisis of 2012. Not because Italy's debt situation had suddenly worsened, but because pension funds across Europe had started selling. Quietly, systematically, without announcement. These aren't speculative investors. These aren't hedge funds betting against Europe. These are institutions responsible for millions of retirees' future payments, the most conservative money managers on earth. And they were dumping European government debt. Why? Because they'd run the numbers. They'd seen what happens when inflation stays elevated while economic growth stagnates. They'd studied what happened to British pension funds in 2022, when bond prices collapsed and nearly destroyed the entire UK retirement system. They learned the lesson. European pension managers decided they wouldn't wait for the crisis to hit. They'd get out early, before the panic, before the headlines, before everyone else realized what was happening. But getting out early had consequences. When pension funds sell government bonds, banks have to buy them. That's how the system works. Banks act as market makers, providing liquidity, keeping markets functioning. Except European banks were already stretched thin, their balance sheets loaded with government debt they'd accumulated during years of ECB quantitative easing. Adding more bonds meant taking on more risk they couldn't afford. So they started demanding higher repo rates, higher collateral requirements, shorter lending periods, making it harder and more expensive for other banks to get overnight funding. This created a feedback loop. Banks demanding higher rates made other banks more desperate for cash. Desperate banks were willing to pay those higher rates, which made the first group of banks even more suspicious. If your competitor is willing to pay premium rates for overnight cash, what do they know that you don't? What stress are they under that they're not admitting? How desperate are they really? Trust began to evaporate, bank by bank, transaction by transaction, until Tuesday night when it disappeared entirely. The European Central Bank noticed first. Their overnight monitoring systems started flashing red around 10 p.m. Repo volumes had collapsed by 73% compared to normal levels. The few transactions that were happening were at penalty rates. Emergency calls went out, not to politicians, not to regulators, to the banks themselves. The first call reached Deutsche Bank's risk management team at 11:15 p.m. The message was simple: we have a problem. The second call went to BNP Paribas in Paris. The third to UniCredit in Milan. By midnight, CEOs across the continent were being briefed on a crisis that officially didn't exist, because that's how modern banking crises unfold, not with bank runs, not with long lines of depositors demanding their money, but with Excel spreadsheets showing impossible numbers, with markets that should be liquid freezing without explanation, with systems that have worked for decades suddenly failing. The emergency meeting in Frankfurt wasn't about finding solutions. It was about buying time. Time to figure out which institutions were genuinely in trouble and which were just caught in the panic. Time to coordinate responses without triggering public alarm. Time to prevent contagion from spreading beyond Europe. But here's what makes this different from 2008. In 2008, the crisis started with mortgage-backed securities, complex instruments that most people didn't understand. Government bonds remained safe havens throughout the crisis. Flight to quality meant money flowed into sovereign debt. This time, government bonds are the problem. When the safest assets in the financial system become unmarketable, there's nowhere left to run. No safe harbor. No government guarantee that can restore confidence. The European Central Bank faces an impossible choice. Raise interest rates to defend the currency and restore confidence in government bonds, which would bankrupt already struggling banks. Or cut rates and inject more liquidity, which would accelerate inflation and further undermine government debt. Either path leads to economic devastation. Higher rates trigger bank failures and recession. Lower rates trigger currency collapse and hyperinflation. They've chosen a third option. Pretend everything is normal while desperately managing the crisis behind the scenes. Increase repo operations without admitting there's a repo crisis. Provide emergency lending without calling it emergency lending. Support the bond market without acknowledging the bond market is broken. It's a strategy that worked in 2012 during the Eurozone crisis. Mario Draghi's famous "whatever it takes" speech calmed markets and bought time for structural reforms. But this crisis is different. In 2012, the problem was fiscal. Government spending had gotten out of control in peripheral European countries. The solution was austerity and structural adjustment. Now the problem is monetary. 15 years of ultra-low interest rates and quantitative easing have created asset bubbles throughout the financial system. Government debt, corporate bonds, real estate, equity markets, everything is overvalued relative to economic fundamentals. You can't solve a monetary crisis with more monetary policy. You can't fix bubbles by creating bigger bubbles. You can't restore confidence by printing more of the currency that's losing credibility. Yet that's exactly what European policymakers are attempting, because the alternative is admitting that 15 years of emergency policies created more problems than they solved, that the system requires a fundamental reset, that the current economic model is unsustainable. Political leaders can't admit that. Central bankers can't admit that. Bank CEOs can't admit that. So instead, they meet in emergency sessions at midnight. They coordinate responses. They manage the crisis day by day, hoping something changes before the system breaks entirely. Meanwhile, the smart money is moving, not dramatically, not visibly, but systematically. European family offices have increased their allocations to U.S. assets by 31% in the past 6 months. Private banks are recommending currency diversification to their wealthiest clients. Sovereign wealth funds are reducing their exposure to European government bonds. They're not panicking. They're not predicting imminent collapse. They're just acknowledging mathematical reality. When debt grows faster than the economy indefinitely, the debt becomes unpayable. When central banks monetize unpayable debt, the currency loses value. When currencies lose value, wealth flows to alternatives. The process can take years, decades even. But the direction is clear. The trajectory is set. The mathematics are inescapable. European banks understand this. That's why they stopped lending to each other Tuesday night. Not because of immediate solvency concerns, because of long-term structural problems that have no political solution. The emergency meeting in Frankfurt ended at 3:17 a.m. No public announcement was made. No press release issued. The official position remains that European banks are well capitalized and the financial system is stable. But the actions tell a different story. Repo rates are being subsidized through emergency facilities. Bond purchases are being accelerated through expanded asset purchase programs. Liquidity requirements are being quietly relaxed through temporary exemptions. These aren't the actions of policymakers confident in system stability. These are the actions of crisis managers buying time while fundamental problems remain unresolved. The crisis isn't over, it's just beginning. And the next phase won't be confined to repo markets and emergency meetings. It will be visible to everyone, measurable in currency movements, bond yields, and bank stock prices. When that happens, when the crisis becomes public, the European Central Bank will face the same impossible choice every central bank faces in the final stages of a debt crisis: default or inflate, economic collapse or currency collapse, immediate catastrophe or slow-motion devastation. History suggests they'll choose inflation. They always choose inflation. Because inflation destroys wealth gradually, almost invisibly, while default destroys it immediately and obviously. But inflation has consequences: social consequences, political consequences. When people can't afford food, they get angry. When they realize their savings are worthless, they look for someone to blame. When they understand the system was rigged against them, they demand change. Not gradual change, revolutionary change. The midnight meeting in Frankfurt wasn't just about banking liquidity, it was about social stability, economic order, political legitimacy, all of which depend on maintaining confidence in a system that's already broken. The question isn't whether that confidence will eventually break. The question is how much longer they can maintain the illusion before reality forces the truth into the open. Because truth has a way of emerging. Markets have a way of clearing. Mathematics have a way of balancing the books. And when they do, everyone will ask the same question they always ask. How did we not see this coming when all the signs were right there? The signs are here now. The emergency meetings, the frozen markets, the desperate policy interventions, the quiet repositioning of smart money. If you know what to look for, the pattern is unmistakable. The system is breaking in real time. The only question is whether you'll recognize it before everyone else does, or whether you'll be another person asking how you missed all the warnings. The midnight meeting in Frankfurt was a warning. The repo market freeze was a warning. The pension fund exodus was a warning. How many more warnings will there be before the system stops pretending and starts collapsing?